Hey, I keep hearing about this Bitcoin crash on October 10th, 2025, where it dropped like 10% in just hours. But people got totally wiped out, even those with only 2x leverage. How does a small dip like that destroy so many traders?
That's a great question to start with. It's wild how something that seems minor on the surface can turn into a nightmare for folks betting big. Let's break it down step by step, starting with what leverage trading even is in the world of Bitcoin. Imagine you're at a candy store with $10 in your pocket. You could buy 10 pieces of candy, right? But what if you borrow another $10 from your friend, so now you control $20 worth, 20 pieces? That's like 2x leverage. You're using borrowed money, called margin, to make your bet twice as big. In Bitcoin trading, people do this on exchanges like Binance or whatever platform they're on. They put up their own cash as collateral and borrow more to buy way more BTC than they could afford alone.
Okay, so borrowing to buy more Bitcoin. But why would anyone do that? Isn't it super risky, like playing with fire or gambling your allowance?
Yeah, it does feel a lot like gambling sometimes. And honestly, it is risky. That's the first objection a lot of smart people raise. But traders do it because leverage amps up the potential wins. If Bitcoin goes up just 5%, with 2x leverage, your profit feels like 10% on your original money. It's exciting, like turning a small bike ride into a rocket launch. Say you have $1,000 and borrow another $1,000 to control $2,000 worth of Bitcoin at $120,000 per coin. You might buy a fraction of a Bitcoin, but if the price jumps to $126,000, that's a 5% rise. You sell and pay back the loan, pocketing $100 profit instead of just $50 without leverage. It's a way to grow money faster when you're confident the market's heading up. But here's the flip side. Losses get amplified too. And in crypto, where prices swing wild like a playground swing at a storm, that borrowed money can bite back hard.
I get the upside, but it sounds scary. Like, if you're wrong, you lose double. So, in that crash, when Bitcoin fell from around $123,000 to under $110,000, that's about 10 to 12%. How does leverage make that turn into a total wipeout?
Exactly. And that's where it gets really intense. Leverage isn't just about borrowing, it's about the rules of the loan. Exchanges set a maintenance margin, like a safety net. If your position loses too much value, they issue a margin call asking you to add more cash. Ignore it, and boom, liquidation. Your assets get sold off automatically to cover the debt. With 2x leverage, a 10% drop doesn't just mean a 20% loss on your money. It can eat your entire stake because the borrowed part pushes you over that safety line fast.
Wait, can you show me with a simple example? Like, pretend I'm trading with my lunch money or something.
Sure, let's make it real easy, like we're talking about trading Pokemon cards instead of Bitcoin. You have $100, borrow $100 more, 2x leverage, and buy $200 worth of cards you think will be worth more tomorrow. Now, if the value drops 10% to $180, you've lost $20 total. But since half was borrowed, you owe that $100 back plus whatever fees. Your original $100 is now worth $80 after covering. But actually, the exchange sells everything to repay the loan first. If the drop hits your margin limit, often around 50% loss on the position for 2x, you're out. In the Bitcoin crash, folks with $10,000 bets at 2x controlled $20,000 positions. A 10% drop meant $2,000 loss. But leveraged, it triggered sales at a loss, wiping their $10,000 collateral. I read on X.com about this one trader who posted, started the day with 50K in longs, 2x leverage. Tariffs news hit, BTC dipped 10%, and poof, margin call. Lost it all in 15 minutes. It's heartbreaking. But it shows how leverage turns a wiggle into a wipeout.
Wow, so it's not just the drop, it's the forced selling that seals the deal. That makes sense why people say goodbye to their savings so quick.
Yep, and it ties right back to why they borrow in the first place. To chase those big upsides in a market like crypto where Bitcoin can double in months. But without understanding the risks, it's like riding a bike with no brakes down a hill. Traders use it to control larger positions, hoping for moonshots. But one bad news, like those trade war fears, and it all unravels. Still, not everyone loses. Some play it safe with no leverage.
Yeah, I see how it amplifies everything, but if the drop was only 10%, why did even 2x leverage cause such total wipeouts for so many?
That's the next layer we need to peel back. It's not just the math on one trade, but what happens when everyone's leverage bets start failing at once.
Yeah, that sounds chaotic. But wait, if it's 2x leverage, doesn't a 10% drop just mean you lose 20% of your own money? Like, why does it wipe everything out? The math feels off to me.
I love that you're digging into the numbers. It's a super common mix-up. And yeah, on the surface, it seems like it should just be double the pain, not total disaster. But the key is how exchanges protect themselves and the lenders. They don't let losses just sit there. They have strict rules called margin requirements. Think of it like this. You're borrowing money from the exchange to bet on Bitcoin, and they want to make sure you can pay it back no matter what. So there's an initial margin. You put up, say, 50% of the total position for 2x leverage, and a maintenance margin, which is lower, maybe 25% or so, depending on the platform.
Okay, so it's like a minimum balance in your piggy bank to keep the loan going.
Exactly. Spot on. If your position's value drops too much and your equity dips below that maintenance level, the exchange hits you with a margin call. That's a warning. Hey, add more money now or we're selling your stuff to cover the loan. But in a flash crash like October 10th, prices move so fast, Bitcoin tumbling from $123,000 to under $110,000 in hours, that you might not even have time to respond. The system auto-liquidates. It sells your Bitcoin at the current market price to repay the borrowed funds. And here's where the wipeout happens. Even with 2x, that 10% drop can push you right over the edge because your collateral gets eaten up covering the full loss on the bigger position.
Can you walk me through the numbers? Like, make it with small amounts so I can picture it.
Sure. Let's use your allowance again. Pretend you have $1,000. With 2x leverage, you borrow another $1,000 from the exchange and buy $2,000 worth of Bitcoin when it's at $120,000 per coin. That's about 0.0167 Bitcoin. Don't worry about the exact fraction. Now, Bitcoin drops 10% to $108,000. Your holding is now worth $1,800, a $200 loss total. But you still owe the full $1,000 borrowed plus maybe some fees. The exchange sells everything to get that money back. So they take the $1,800 and use it to repay the $1,000 loan. What's left? $800. But wait, your original $1,000 collateral? It's gone. Wiped out because the loss exceeded what you put in. In reality, liquidation often happens even sooner to avoid bigger shortfalls. So you might lose the full $1,000 on a drop that's less than 10% if volatility spikes fees or the margin threshold is tight.
Whoa, so it's not a straight 20% loss. It's the whole stake because they sell to protect the loan. That explains why it feels like everything vanishes.
Yep, and it gets worse in a crash. For those over $19 billion in liquidations, thousands of traders were in long positions betting Bitcoin would rise with leverage like 2x, 5x, even 100x on some wild platforms. A guy on X.com shared his story right after the crash. He had $30,000 in a 2x long, controlling $60,000 worth. Tariff news from Trump hit, Bitcoin plunged 10%. And his position liquidated in seconds. He lost the full $30,000, not 20%, but all of it, because the automated sell-off locked in the loss before he could blink. It's like if your candy stash melts in the sun and the friend you borrowed from takes back double what you owe just to be safe.
That's brutal. I saw posts where people said they lost their entire net worth in 10 minutes, like saying goodbye to their life savings. How does it happen that fast?
Speed is the killer in crypto. Exchanges use bots and algorithms that monitor positions 24/7. When the price hits your liquidation level, often calculated in real time based on volatility, the sale triggers instantly, no human delay. In the October crash, it was a cascade. One liquidation sells Bitcoin, pushing the price down a tiny bit more, which triggers the next guy's margin call, and so on. Your 2x bet might seem safe on paper, but in a 10 to 12% plunge fueled by trade war panic, it evaporates because the math of leverage doesn't forgive quick moves. Remember, 2 weeks before, Bitcoin was lower, around $100,000. So folks thought it was climbing forever and loaded up on longs. But that overconfidence turned a dip into doom.
Got it. So the rules and speed make even a small drop total for leveraged folks. It's not just losing double, it's losing it all to cover the borrow.
Right, and that's why education on this stuff is huge. It saves heartaches. But imagine if not just one or two traders get hit, but thousands all at the same time.
Yeah, what happens then? Does it make the whole market freak out even more?
Oh, absolutely. It turns into total chaos, like a domino line where one tip sends the whole row crashing down. That's the chain reaction we're talking about in the October 10th Bitcoin flash crash. Picture this. Thousands of traders all betting big on Bitcoin going up, those long positions I mentioned, with leverage like 2x or higher. They're comfy at $123,000 per coin, thinking the ride's just getting started. Then bam, President Trump's announcement hits about slapping 100% tariffs on Chinese imports. Trade war fears explode across the news, and everyone starts selling in panic. Bitcoin dips a few percent, maybe 2 to 3% at first. But for those leveraged folks, even that tiny wiggle hits their margin limit.
So one sell-off starts it, but why does it snowball? Like, doesn't the market just bounce back quick?
It could in a normal day, but not when automated systems kick in. Exchanges run bots that watch every position like hawks. As soon as a trader's equity drops below the maintenance margin, say after that initial dip, the bot sells their Bitcoin automatically to cover the loan. No waiting, no phone call. In the crash, this happened to so many at once. Over $19 billion worth of long positions got liquidated in hours. One sale floods the market with Bitcoin, pushing the price down a smidge more. Now it's 5% off highs. That triggers the next bot. More sales. Price drops to 7%. And suddenly it's an avalanche. I saw this thread on X.com from a trader in Asia who woke up to it. My 2x long on 0.5 BTC, $60K position, got wrecked at 8% down. But then the feed showed 500 liquidations per minute. It was like watching a black hole suck in the whole exchange. Feels exaggerated at first, right? Like, how can one person's forced sale mess up the whole market? But with everyone over-leveraged on the same bet, Bitcoin to the moon, it's interconnected. The tariffs news was the spark, but the leverage was the dry grass waiting to burn.
Yeah, that objection makes sense. One loss shouldn't doom everyone. But with all those bots selling, it just keeps feeding itself. Kinda scary how tech makes it worse.
Spot on. And it's not just scary. It's a lesson in how markets can amplify fear. Back in the crash, Bitcoin was riding high after climbing from 100K just weeks before, so tons of newbies piled in with longs, borrowing heavy. Trump's tweet storm on tariffs, calling out China on everything from tech to EVs, hit like a gut punch. Investors worried about global slowdowns, supply chain messes, even inflation spiking. Sell orders poured in from big players too, not just small traders. But the real killer was the cascade. Those $19 billion in liquidations weren't spread out. They clustered around key price levels. As BTC hit 115, a wave of 2x and 5x longs liquidated, dumping more supply. Priced to 112, another wave. Down to 110, and it was over $10 billion gone in the first hour alone. Anecdotes on X were everywhere. One mom from Texas posted, "Took a loan for 2x on my savings, thought it'd pay for kids' college. Tariffs dropped the news, bots ate my 20K in 20 minutes. Watching the chart was like my heart stopping." Her story got thousands of replies, all similar wipeouts. It's not one person, it's the herd mentality plus machines creating a feedback loop.
Herd mentality. Yeah, like everyone running from a bee and trampling each other. So the tariffs were the bee, leverage the crowd, bots the stampede. Got it. But even with that chain, why didn't exchanges pause or something to stop it?
They could have in theory. Some do during extreme volatility. But crypto's 24/7 and decentralized. So pausing one exchange doesn't stop the global flow. Regulators are still catching up, unlike stock markets with circuit breakers. In this case, the fear from trade wars made it global. Asian markets opened panicking. U.S. traders followed. The $19 billion figure? That's from reports by CoinGlass and such, tallying forced closes across Binance, Bybit, everywhere. Most were longs betting on endless uptrend, ignoring risks like geopolitical shocks. Trump's announcement wasn't out of nowhere. Rumors had been bubbling on X for days about U.S.-China tensions. But the 100% tariff bomb lit the fuse. Result? A 10 to 12% flash drop that felt like 50% to leverage traders, wiping billions because each liquidation shaved the price lower, hitting more stops.
Makes the exaggeration feel real now. Like it's not just bad luck. It's a system designed for speed that backfires big.
Exactly. And understanding that chain reaction shows why flash crashes hit so hard in crypto. It's why pros always say diversify and don't over-leverage, especially when news like tariffs can flip the script overnight. But here's a wild part. While longs got crushed, not every dollar just vanished into thin air.
Wait, so where does all that liquidated money actually go? It can't just disappear, right?
You're spot on. It doesn't just poof into nothing like magic smoke from a cartoon. That's a huge objection people have. If $19 billion got liquidated in that October crash, someone or something must end up with it, right? Let's unpack where it really flows, step by step, because understanding this clears up a lot of the mystery around these wipeouts.
Yeah, I mean, money's got to go somewhere. Like, if I lose my allowance in a bet, does it just vanish, or does my friend pocket it?
Great way to think about it. Exactly like that bet with your friend. In leverage trading, when a position gets liquidated, the exchange steps in and sells your Bitcoin, or whatever asset, at the current price to pay back the borrowed money. That borrowed cash, it goes straight to the lenders, who could be the exchange itself, other users providing liquidity, or big institutions loaning out funds. So the $19 billion isn't lost in the sense of gone forever. It's mostly repaid to those who funded the leverage. Fees might skim off a bit for the platform, but the core chunk covers the debts. In the crash, as Bitcoin tumbled from $123,000 to under $110,000, all those long positions, folks betting it'd rise, got sold off in a rush. The money from those sales went to settle the loans, leaving the original traders with zilch, or even owing more if fees piled up.
Okay, so it repays the people who lent the money for the bets. But what about the traders who lost everything? Their net worth just evaporates?
Yeah, for them it feels like evaporation because their collateral, their own cash that backed the trade, gets used up in the repayment. Picture it like this. You borrow $100 from a buddy to buy a $200 video game bundle, thinking it'll be worth $250 soon. But the price crashes to $180 overnight. Your friend takes the $180 to get their $100 back, and your original $100 you put in, it's wiped to cover the gap, plus maybe interest. You're left with an empty wallet, even though the total value didn't drop to zero. In the Bitcoin crash, that happened on steroids. Net worths vanished in minutes because the cascade was so fast. Positions liquidated one after another, selling at ever lower prices. I dug into X.com stories from that day, and one trader from California tweeted, "My 100K portfolio, 3 times leverage on longs. Tariffs hit, liquidation at 112K. Sold everything for 70K worth. Lenders got paid, I got a zero balance alert. Said goodbye to my emergency fund in 8 minutes." Heartbreaking. But it shows the money didn't disappear. It shifted to cover the risks others took by lending.
Shifts to the lenders, got it. So the exchanges and big players kind of win when everyone else loses?
Not always win like a jackpot, but they get protected. Yeah. The system's built that way to keep the lending pool safe, so more people are willing to provide margin funds. But here's the twist that makes it even more interesting. While longs got crushed, the flip side, short positions, actually profited big from the drop. Shorts are bets that Bitcoin will fall, often using leverage too. When prices plunge, their gains explode, just like losses do for longs. In that $19 billion liquidation wave, a chunk of the money effectively flowed to those short sellers because every forced sale from a long pushes the price down, padding the shorts' pockets. It's like a seesaw. One side crashes, the other shoots up. Reports after the crash showed short profits hitting billions too. Traders who went short walked away with fat gains, sometimes turning 10K into 50K in hours.
Whoa, so someone's always on the winning end? That's kind of fair but wild. Like the total money in the market stays the same, just moves around?
Pretty much. Markets are zero-sum in those moments. For every loser, there's a gainer nearby. The $19 billion in liquidations repaying lenders keeps the system running. Shorts cash in on the downside, and exchanges collect tiny fees on the chaos. But for the wiped out traders, especially newbies who dumped their whole savings into leveraged longs, it was devastating. Bitcoin had been climbing from 100K just 2 weeks prior, so everyone felt invincible, until the tariffs news flipped it. That 10 to 12% drop wiped net worths because the sales locked in losses at the worst times, with no escape hatch. One X post that went viral was from a young guy in Europe. All in with 2X on my 50K inheritance. BTC to 110K, liquidated. Lenders took it all. Watching my future disappear as the chart bled red. Stories like that make you realize it's not abstract numbers, it's real lives.
Yeah, I feel that now. The money repays debts and boosts the opposites, but the losers feel it hardest. Makes the whole crash less mysterious, more like a big shuffle.
You nailed it. And seeing how it all connects shows why crypto's so thrilling and terrifying. But you know, not everyone was caught off guard. Some traders actually saw the storm coming and positioned themselves to ride the wave the other way.
Yeah, that makes me wonder. How could anyone actually see that crash coming and bet against Bitcoin? Like, predicting tariffs or a big drop sounds impossible. More like guessing the weather in a hurricane.
It's a fair objection for sure. No one's got a crystal ball. And yeah, it can look like pure luck from the outside. But a lot of it comes down to sharp eyes on the warning signs, especially for experienced traders who've been around the block. They don't predict the exact news, but they spot the brewing storm. In the lead up to October 10th, 2025, there were whispers everywhere about U.S.-China tensions ramping up. Trump's been vocal on X.com for weeks, posting about unfair trade deals, tech theft, and slapping tariffs on everything from phones to car batteries. Savvy folks, market watchers, analysts, even big funds, were tracking those rumors like detectives following clues. They noticed Bitcoin sitting at all-time highs around $123,000, with everyone piling into long positions, over-leveraged and cocky after the climb from $100,000 just 2 weeks earlier. That overconfidence screamed bubble to pros. So they started shorting, betting on a fall, using leverage to control big downside plays.
Shorting over-leveraged longs? So, like, they saw too many people borrowing to bet up and figured it'd backfire?
Exactly. You got it quick. It's like watching a playground where every kid's stacking wobbly towers of blocks as high as they can, borrowing extra blocks from friends. A smart kid sees the towers leaning and starts betting they'll topple, maybe even giving a tiny push. Experienced traders did that with Bitcoin. They opened short positions, borrowing BTC to sell high and buy back low if it dropped. Tools like sentiment trackers on X or news aggregators showed trade war chatter spiking, posts about Trump tariff threats trending, economists warning of global ripple effects. One hedge fund guy even tweeted days before, "Longs are drunk on the rally. China tensions plus over leverage equals incoming short squeeze. Positioning accordingly." When the 100% tariff announcement hit, those shorts exploded in value. A 10% drop? For a 2x short, that's a 20% gain on their stake. But some used higher leverage, turning small bets into windfalls.
Okay, so not luck. It's paying attention to the vibes and history. But give me an example, like a real story from that day.
Sure, I scrolled through X.com archives from the crash, and there are tons of contrasts that hit home. Take this one trader, let's call him Alex from New York. He posted a thread that blew up. He'd been following the tariff rumors since September, seeing how past US-China spats tanked markets. With Bitcoin overbought and longs everywhere, he went short with 5x leverage on a $200,000 position. When the news dropped and BTC flashed to $110,000, his short profited over $100,000 in under an hour. He screenshotted his gains. While you longs get wrecked, I'm up 50%. Knew the trade war spark would ignite. Flip side, a newbie in the replies shared her wipeout. $30 million long at 2x. Thought BTC was unstoppable. Tariffs news, cascade hit, liquidated to zero. Lost my house down payment. Alex wasn't psychic. He used data. Chart showing high funding rates for longs, meaning everyone was paying extra to stay in bets, a red flag for reversals. Others shorted by spotting whale movements, big players dumping early. It's skill built on patterns. Crypto's volatile, but geopolitics like tariffs always stir the pot.
Patterns and clues. Makes sense why some win big while others crash. So even in chaos, there's a way to play the other side if you're watching close.
Yep, and that's the edge experience gives. Not everyone shorts perfectly. Plenty of them get burned too. But those who did in the October crash walked away richer, balancing out the long's losses. It ties back to why leverage cuts both ways. Amps wins as much as wipeouts. Now, thinking about all this, doesn't it make you curious why a seemingly small 10% dip felt like the end of the world compared to older crashes? Especially when Bitcoin was way lower not long ago.
Totally. Bitcoin dipped below 100K just weeks before, and no one freaked like this. Why was this one such a monster, with people losing life savings in minutes and billions vanishing?
Great point. And it's not the size of the drop, it's the perfect storm of factors that made it sting so deep. Sure, Bitcoin had been lower, hovering around $100,000 mid-September after some profit taking. But by October 10th, it had surged 20% on hype about adoption and easy money vibes. Folks loaded up thinking the climb was endless, pouring in record cash with heavy leverage. Over $19 billion in open long positions alone. That overextension meant even a 10 to 12% correction hit like a freight train. Past crashes, like the 2022 bear market, saw 50 to 70% drops. But they unfolded over weeks or months, giving time to adjust or exit. This flash, hours. Trump's tariff bomb landed mid-trading, igniting instant fear of trade wars choking global growth. Think supply chains for mining rigs, chip prices spiking, all crypto killers. Bots amplified it. Liquidations cascaded faster than ever, with platforms like Bybit reporting 1,000 plus per second at peak. X.com lit up with raw pain. Goodbye, my 500K nest egg. Gone in 10 minutes on 2x long. Tariffs stole my future, one dad wrote, his post getting 50K likes. Millions lost because net worths were all in, no diversification, riding the recent high without buffers. It felt huge because the market was frothy. High leverage, FOMO highs, sudden macro shock, turning a wiggle into a wealth eraser. But here's the silver lining. Crashes like this shake out the weak bets, paving for smarter plays later.
Yeah, the speed, the hype before, and that news punch explains why it wrecked so many lives quick, even if the drop wasn't massive. Kind of shows how fragile it all is, but also why learning this stuff matters.
You summed it up perfectly. Deep understanding like yours turns scary stories into lessons. Crypto's wild, but spotting those patterns keeps you ahead, not under the wave.